Welcome to the Mid-Market Edge podcast, where we uncover operational insights for private equity-backed portfolio companies. I'm your host, Kevin Bonfield, and over the last 30 years, I've had the privilege of working with fast-growing entrepreneurial teams, helping them scale, tackle challenges, and seize new opportunities. On this show, we'll talk to industry experts and seasoned leaders who will share practical strategies to drive growth, boost efficiency, and create value in the mid-market. Get ready for an insightful, engaging conversation that dives deep into the real-world issues facing your business.
Hello, and I want to welcome Dave Parker to the Mid-Market Edge podcast. I've known Dave, I think, for a couple of years now, when he was the CEO of the Entrepreneurs Organization, but he's really a multi-time founder. And so I wanted to get Dave on as we're talking about how you prepare for a transition or an exit or a funding event. I wanted to talk to Dave about what that experience is like and what he's learned. So Dave, welcome to the podcast.
Thanks, Kevin. It's great to be here. Thanks for hosting. This is a fun topic that I truly love because from the founder's perspective, so much of this process is opaque until you're in the middle of it. And then when you're in the middle of it, you're like, how come I didn't know this? This would have been super helpful.
Wouldn't it? So tell me a little bit. I had a very short introduction. Tell me more about your background and your history and experience in this space.
Sure. So I'm a six-time founder. This company is my sixth company. So Trajectory or gettrajectory.com is the new website, is the sixth company I've started. I was fortunate to sell three of them. So two of them failed. And in that process, mostly I've been in the innovation economy or tech companies, one services company, and then I've done a couple of CEO gigs and a couple of CEO turnarounds as well. But for the most part, I've been in the innovation economy, which was interesting in the learning with EO. And in the EO world, you have literally thousands of coaches out there in the world. You've got Vern's organization in scaling up. You've got EOS. You've got Bloom Growth. You've got the science of scaling folks. There's tons and tons of folks who focused on scaling your organization from 1 million to whatever, 2 million to whatever. But one of the things I found out consistently as I talk with folks is, what do I do when I'm preparing to exit? And do your coaches have experience in the exit process? And the funny thing is I remember back to my first company we sold in 2002. So early in 2002, right, I walked next door to Barnes & Noble to find a book about merger and acquisition. And ironically, it was written by Andrew Sherman, who was the chief legal counsel for EO and incorporated EO in 1987. So Andrew's a friend and great counsel. And it was very mechanics driven. Right. So here's the process. Here's what you do from a mechanics perspective. Here's what you need to think about fiduciary duty as a board member. All that was super helpful. The problem was the stuff you needed to get done before you got there was missing. Like, what is this thing called quality of earnings? And what does that mean? And when a buyer looks at your financials, how do they think about, can the company run for 6 months without you? And is it dependent on Kevin or Dave? Right. So as founders, we're generally compelled by an idea, right? We can't not do it, right? It's not a matter of, sometimes when the economy is challenging, I've been on a panel one time with a VC who said, well, entrepreneurs look at this as a good time to start a company because the economics are better. I think that's complete and utter BS, because I think entrepreneurs are generally compelled by an idea, and then we're like, we can't not do it, right? So, So that intuition is great, except when you need a much more disciplined approach to get ready to exit, because there's a bunch of factors they can really detrimentally impact your enterprise value. And you'll hear me say enterprise value a lot as I'm writing this book now. So the first book was Trajectory Startup, was really focused on the how startup companies make money and what the revenue models are that are used in tech. By the way, there's 14. So how your product should be unique, but how you make money shouldn't be unique. In fact, it's never unique. And watching that data now for almost 12 years, there's basically no new revenue model. At the front of it, you probably remember Groupon. And Groupon had this new revenue model, but it wasn't really new. It was really commerce and lead gen. And Groupon, of course, booked that as top line revenue when it really wasn't revenue, right? It was only their commission was the real revenue. And if you probably remember too, there's tons of copycats for Groupon. We're like just like Groupon, but we're in Dallas. And So today, what we're seeing now with AI is the SaaS apocalypse happened about 3 months ago, right? So Salesforce went down in value 30 or 40% because it's not about seats anymore. It's about tokens. And everybody's scratching their heads going, well, what's a token? Right? So the reason I bring that up is just the simple concept of pricing, right? Or what revenue model you use can dramatically impact your enterprise value. So
Right.
a lot of companies that are in EO, YPO, and Vistage tend to be in the 90%-ish companies of manufacturing, construction, and services. So typically in that world, you're talking about what are your trailing 12-month revenues? You'll see a lot of companies, though, like in business services these days, or home services is a great example, right? Where somebody says, hey, well, we have a contract to put up your Christmas lights and we have a contract to do your pest services. So we bill you monthly. So it's a subscription. It's not really a subscription. They don't come every month and deliver a service, but the payment structure is such that they're looking at shifting the dialogue from trailing 12 months to future 12 months less churn. It's a simple math model, but it changes the variable of how the enterprise value of the company gets calculated. And if you're thinking about selling and you're thinking about pricing, you want to run that pricing change as part of your private equity playbook before the private equity company buys you. So you as the founder should take advantage of that. And that's really my premise of the new company is how do we help founders run the private equity playbook for themselves, extract as much of that value as possible, and then present to a private equity or a strategic buyer.
Yeah, and you got so much in there, Dave. So let's break some of that down. So the first thing, just so that we've got the note, is 14 different types of pricing or revenue models, and that's from a book you wrote, right?
Right. So Trajectory Startup has 14 revenue models used predominantly in tech, but what you're seeing in the AI world is the traditional businesses are blending into some of those models, and that was based on tracking 2,654 companies over a 5-year longitudinal study. So it turned up being a much bigger project than I anticipated, but that's now got about 12 years worth of data assigned to it as well. Those revenue models then tracked the public company comparables. So for example, DocuSign is a subscription business. It trades in a range on a price to sales ratio of 6 to 12 times price to sales versus price to earnings, because most startups don't have earnings at this point. So if you're going to sell a strategic company to somebody like DocuSign, you could look at your revenue and say, well, our company's worth roughly this amount on a price to sales ratio. And obviously there's discounts for and pluses for, but the idea there is it is one thing you can look at. It's not the only thing that helps you value your business, but it is one area you can look at to value the business.
Yeah, and the different revenue models have different EBITDA valuations. The number of turns that somebody will buy for it, and it's perhaps really good bedtime reading, but to give you insight into the different ways that you can structure your pricing and the way that you engage with customers can make a massive difference in terms of what your company's valued at.
Totally. And by the way, in addition to when the private equity team buys you, they're going to sit back for the first 30 to 60 days and watch everything, right? And they're bringing capital at play. And for a lot of founders, we've lived through making the first payrolls, and in my personal experience, I sold a 1966 Thunderbird convertible to make a payroll. So when we look at, gosh, should we put debt on the company? We're always like, we probably shouldn't. Well, I have news for you, right? When a private equity firm buys you, they're going to leverage it up, and your credit access is one of the things that they look at. Mm-hmm. So one of the things you should consider is, could we put credit leverage against this or not and help us grow faster? Because after they sell, they're going to do that, right? So, and if you haven't raised your prices in 3 years, which was the average time, by the way, in the data set, that companies had not raised their prices. If you haven't raised your prices in 3 years, you should look at raising your prices, because after the private equity company, they're going to raise your prices. Now, whether they grandfather in old customers or first-time customers, totally different set and process question. But yeah, pricing is one of the things you have to look at.
Yeah, exactly. So, but the other thing that you talked about is there's difference between the types of exit you have, which I think is combined somewhat with the type of business that you have, right? In the tech world, I've done a lot of work in commercial glass installation and elevator services, right? Yep. Google, less interested in those businesses, but for some of the innovation economy businesses, that's the path that they're going down.
So there's two Well, there's basically four, with a fifth variation of how companies exit, right? 1 to 5% of companies, depending on the season, will go IPO. Congratulations, you're a unicorn. I think even as we speak, RocketX is getting ready to go out this week. Going to be the largest IPO of all time, bigger than Aramco. 1 to 5% of the companies at the bottom end sell in asset sales. Right. So they sell it. And you see this growing percentage of ESOP based sales, which is employee stock option plan resales, where the founders are a particular age and they realize they can't sell the company to anybody else. So they're going to sell it to the employees. So those represent roughly 10%. Then you've got about 60% of the companies sell to a strategic buyer, and the other 30% sell to a financial buyer. And this varies by quarter, kind of wildly based on is the IPO window open and such. But if you look at the two biggest blocks, right, the strategic buyer in the innovation economy company, so technology-enabled services, predominantly strategic buyers. In the services businesses, the numbers flip, because I'm not buying a product roadmap, I'm buying financials and revenue and earnings. So private equity buyers are looking for a financial transaction. You'll have more MBAs examine your books than you've ever experienced, right? With a great level of discipline. And the strategic buyer, everybody wants to sell to Google. The question is, are you really sellable to Google? Right? I have a friend here in Seattle who has sold 3 companies to Google. He's the only person who's ever done it, right? He individually is a unicorn, but he's figured out the formula of where do I think they're going to go in a category, and he'd have an innovative idea, and he would then end up selling that company for Google. Those types of strategic exits don't sell on a multiple of EBITDA, right? So they sell on the product roadmap, the product, and the team. And the buyer, the strategic buyer, is making a decision. And it's a very calculated decision, just like the EBITDA decision, by the way. The decision is, can we, looking at this product, can we recruit a team, onboard and ramp up the team, build the product that competes with their current product and builds for an 18-month roadmap forward? If we can build that in 18 months, we're going to build it. If we can't, we're going to buy it. And I have a friend who sold his company to Google for $40 million. It had 0 revenue, right? And some people scratch their head and they're like, how can you even do that? And the answer is, well, it's all about product roadmap. Mm-hmm. And it's also, there's a downside there that you have to realize too. And in the case of any big tech company, they're like, what's the reputational risk if we try to build it and we fail? So that's why you see these big numbers getting thrown out for companies. You're like, total head scratcher. And here, as a founder, you've been grinding on the same company for 9 years and you're like, I'd like Google to buy it, but you're probably not in the product roadmap technology business is probably one. So that's the strategic side. Right. So the other side though is the multiple of EBITDA, private equity, financial buyer side. So when I first talk with a founder who is more technology savvy or more of an innovation economy, what I remind him is you have to run 2 different playbooks at the same time, right? Which means you need to look at your quality of earnings. You need to look at the revenue growth. You need to look at profitability, or when you can be profitable. Because what you want to do is at very least shop private equity at the same time that you shop strategic buyers, so you have a straw man to go against. And it doesn't always happen, but in general, more often than not, there's a higher percentage you're going to talk to what's called a strategic private equity, in which case the private equity firm has backed a platform company, and they're looking to plug in new companies around that. So there really is a strategic buyer that's backed by private equity is the nuance, but those happen all the time as well.
Yeah, and one of the things that we see is that the number of platform sales over the last 10 years has stayed relatively, it's grown a little bit, like single-digit growth per year in the US, but the number of add-on acquisitions, those bolt-ons that go to the platforms, has more than doubled per platform over the last 10 years. So those kind of strategic add-ons that you're talking about really has taken off over the last 10 years.
Let me give your audience an example. So typically a private equity firm will have a thesis in a particular area, and they'll have a CEO who knows that particular area. So one company that we sold a few years ago was providing data and geolocation data. So the founder had come out of U.S. Army Rangers. And the question is, what's the ground truth of what's really going on there? Mm-hmm. And so the private equity firm had bought a platform company, and the plug-in for them was they did geo-based data that would track there's civil unrest going on in this area. Do you have a plant there? Mm-hmm. Right? Or there's a plane went down here. Do you have any facilities or people there? So it was trying to give big corporations timely access to data that they wouldn't have any other way. And their company was a plug-in to a bigger platform company that was all about data intelligence for corporations. So the private equity firm had backed that thesis, and they were just a plug-in that slotted into that particular asset. So that's an example of a platform and product play. In the private equity side, what you typically see, I'll go back to the home services example. The home services business is geographically constrained by nature, right? There's no, if you're in Dallas and I'm in Seattle, right? The answer is, I want somebody in Albuquerque. The answer is, we don't have a referral for that. Right. So you see that by contrast on the private equity side, those are roll-ups generally. So we're trying to consolidate the back office, put in value of the brand, right? And a vendor come to fix my the heater element on my dryer was out, right? So that's really a question of, you have a call center that then takes all the calls, right? And whoever's first to get the text or the call out typically wins the business. And that efficiency and economy is what you're getting by doing the roll up. So the smaller companies then have a more difficult time to compete. Right?
Yeah. Yeah. No, I worked for a startup. This is a long time ago. And one of the things we were looking at was home services. We started off and we talked about it as, we're trying to do for home services what eBay did for products. And we were competing against ImproveNet and Angie's List. Angie turned out to be the winner in that particular category. But it was fascinating that the first company to respond, I think, won between 60 and 70% of the business. Because as long as you were showing up with something that was credible and seemed reasonable from a price perspective, you were there.
Yeah. Yeah. And and they're viewed as the number of Yelp things that come in at the same time. And it depends on the system, but you can see where it's going from whether it's lead gen for organic search for home services, or whether it's fulfillment and delivery and back office. A small vendor has a hard time competing. So the question is, do you become part of the roll up or not? Right. And I think that gets to the bigger heart of the question, Kevin. I hear a lot from founders is, when should I consider selling? Mm-hmm. Right. And there was an interesting study recently from there's an Exit Institute that interviewed 125,000 founders. So it's Exit Planning Institute did the research, and it was 2024 data. And they asked the founders, privately, not publicly, not what's your public message, but privately, why do you consider selling? And it wasn't a surprise. The top three answers. Number one was, I'm burnt out. Like, I've been doing this a long time. I've been pushing this rock uphill a long time. This is hard. So number one was, I'm burnt out. I'm done. Number two was liquidity. Right. So as we come to the end of the baby boomer generation of business owners, trying to find a home for the business is a challenge. And number three was being opportunistic, and strategic opportunity really was the third one. Mm. Now, that's a huge contrast from the public message, because the public message is, this was best for my employees and it's best for my customers. But there's two sides to that message, the two sides of the coin here on that one. So if you're a founder and you're thinking, I need to think about how I prepare to exit my company before I need to. And then you have the real stressful ones, which is, I have a health issue, or things that are externally driving the boat that you need to manage through the process. So personally, I'm a cancer survivor. So I get the fact that if you have this thing going on in your life, you're still trying to negotiate your best deal, knowing that there are some things that are private, and you have to be super cautious about how you manage that message.
Yeah. Yeah. So as you were talking about you started off the conversation talking about EOS and Bloom Growth and scaling up, which do incredible and valuable work for companies, helping them become more profitable, become more sustainable, right? But you talked about the difference between the work that they do and then being ready to actually go to market and go through that transition. So maybe you can talk a little bit about that and how that then triggered the path you're going down with trajectory.
Yeah. So I think the biggest differences are a lot of times when any new coach meets with you, right? The question is, hey, Kevin, where do you want to go? Well, I want to go from 3 million to 6 million. I want to go from 6 million to 15 million, right? And the answer is it's a fairly generic set of things versus I have a time frame to prepare to sell the company. It's 18 to 24 months.
Mm-hmm.
Why 18 to 24 months? Well, it's tied to another personal decision around your personal asset management and personal wealth management. Now, for a lot of us founders, the challenge is 150% of my asset class is tied up into this one thing, right? It was a second mortgage on my house. It was my credit cards, right? I built my first company on American Express, right? So that we're so tied into this one asset class that when a wealth management person comes to us and says, hey, Kevin, we should talk about your wealth management. You're like, I'm embarrassed to talk about it because I own this one thing.
Right.
And I don't really have any other money there's no other money for you to manage. And since this one thing isn't liquid, why should I talk to you? But give you a couple examples. So qualified small business stock, or QSBS, is part of the 1202 exemption for the federal law. So some states don't have it. It's an ongoing challenge right in. But in general, it says if you have a C Corp and you've held that C Corp for greater than 5 years, when you go to sell it, your capital gains on that sale on the first $10 million is zero. Versus if you own an LLC and you sell that same company, you're going to pay tax at a regular income level, 35 to 38%, whatever the number is, right? And the capital gains savings on a QSBS is huge. And oh, by the way, if it's more than $10 million in the exit, you can create a trust for each of your kids at $10 million each and hedge another. Now, I don't make up the tax law. I'm just telling you that founders should be aware of what the tax laws are before they exit. Mm-hmm. So 18 to 24 months before you exit, you should be considering, hey, how do I think about these things so that you've got the right things in place, right, to make it work. Right. So that's just one example of I need to be prepared for it. The second example is the day you get the letter of intent. So typically what happens is you get an inbound call, right? And the call is like, hey, Kevin, this is Dave. I'm an associate with blah, 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 private equity firm. My partner would like to meet with you. We think you'd be a really great company. And I have to say, after raising money for a number of enterprises, right, when somebody finally calls and says, we want to talk to you, it's like, I've finally arrived. This is awesome. Not realizing that it's a junior analyst whose job is to just dial for dollars and find companies who have had a recent press. And then you meet with their partner and find out that you're too small. Right, you're doing $1 million or $2 million in EBITDA, and they really want you to do 4 on 10, and 10 million is kind of the minimum revenue, and 4 million EBITDA. And then what they're really looking for is to get you at a deal before you know that you should be shopping it, because if they can lock in a better deal, that's what they're after. And no offense to them, like it's a heck of a business model. You're leading with good news. The challenge is that the day you sign that letter of intent, the average final price will float down between 10 and 30% if the deal doesn't break entirely. So give you a few examples under this category called quality of earnings. And quality of earnings is broken down into 4 quadrants. But I'll give you one that just has a dramatic impact. Let's say you're a $10 million business, but 40% of your revenue comes from one customer. So we call that a customer concentration problem. 40% means that you might still get a deal done, but half of the payout is going to be done in an earn-out after you prove you can keep that customer and diversify the customers. And some founders right now are like, no, I am never going to take an earn-out. The answer is, well, 40% customer concentration is a structural change to the deal, not a price change to the deal. Right? Because that's 40% or above is just a killer. 25% says we're going to flag that issue, potentially move it into a segment thing, but also assign a lot of risk to that customer concentration being 25. 15 is kind of a red flag. So 15% is kind of a red flag. So customer concentration typically falls into the categories, and I have a bunch of entrepreneur friends who know that. And I was talking with one recently, and his response was, yeah, I know I need to get the sales and marketing machine going again. But he's riding a wave of a really, really good customer. And until the customer just recently was like, you need to take your rates down by 30%. Right. And then it's like, now I have a sense of urgency. So the problem is you get the letter of intent. They start digging through your financials, realize you've got customer concentrations, and they're like, you know what? The price is going to go down, and the price is going to go down between 10 and 30% on the deal. And now you're in a conundrum as a founder is, do I want to go out now and shop this? So my perspective on it is go out and get these things fixed in advance. And then when you go to shop it, create competition. By creating competition, you should be able to drive the price up. But if you don't have competition, you won't drive the price up. You're going to get an LOI and the price will float down. That's what the numbers typically do.
Yeah, and the chat, as you were saying, there are 4 things in QOV, right? The customer concentration is one. The actual, is that the EBITDA that you said you have when you apply GAAP principles to the numbers that you have can also bring you out in a place where you go, well, I thought that I was making $2 million a year, but it turns out that I was only actually making 1.5 when I deal with add backs and so on. And it does it causes the deal to be less attractive to you, but it also causes the other side to go, am I buying what I thought I was buying? And there's a whole risk conversation then.
Even a more extreme version. So revenue recognition is one that comes up a lot. Right. So especially in software companies and SaaS businesses, you take in $100,000 contract is to deliver services for a year, but you're on a cash basis instead of an accrual basis. You're not, your quality of earnings isn't up to standard. Right. So, and because in the early days you're focused on cash and surviving, you kind of go with it. Right. So that revenue recognition problem, I'm in an LOI on my very first company to sell. The buyer, we've signed an LOI, we fly, I won't say where, we fly to the company, and the advisor banker who is with me isn't really a broker. He's more of I've done this a couple times before. I'm not really felt more like a real estate person who doesn't care what the property sells for, but only cares about getting their commission. I'll say that.
Okay.
And they drove a Panzer line through our defenses. Right. And the price was just like, just crushing down until I finally pushed away from the table, got up and said, we're done here. Right. And it was the thing I want to remind founders is, for most of us founders, I've been fortunate, I've sold multiple companies. For most of us, we do this once. And the person sitting on the other side of the table from you has done it 100 times. Right. And they have a plan. Right. And we're going in kind of naively trying to do that, right? And it's like, no, you need to, so your quality of earnings, revenue quality is important. Defensibility of EBITDA is important. Your margin hygiene is important, right? And then there's this other concept that most founders don't know about until they get to the LOI, and it's called your net working capital PEG. And the PEG is not an acronym. It's just a PEG, right? So if it takes $2 million to run the company on a monthly basis, and you come in with $2.4 million in accounts receivable at the date it closes, you net $400K. But if you come in at 1.6 million in working capital, then $400K out of the proceeds will be deducted from your proceeds. And most founders don't know that what the working capital PEG even should be. And because it happens so early in the LOI process, they're surprised by it. And then they're trying to calculate it. And then it's like, now your back's against the wall already. And again, these are all things that we look at and do we'll come in and do a fixed price board ready deck for you to say, listen, here are the things you need to consider. Right. And it's something you can track quarter to quarter for the board to say, are we making progress on these things? So dependency on the founder, right? So can the business run without you for 60 days?
Right.
And I can't tell you the number of times I've talked to founders who are like, yeah, we're really good at that. And then I go into a dialogue with the founder and he's like, I did this and I did that. And I'm like, oh my God, you need to stop saying I, and it needs to be about the team. And it sounds like a little trivial thing, but
Yeah.
when the buyer starts hearing it, it's not little or trivial.
Right. Right. Because they're trying to work out, you're looking at this as, this is the thing that I built, I'm passionate about, I love the team. And they're going, this is an asset that I am buying. And by the way, I've got a fiduciary responsibility to all of my investors. So I need to make sure that I get the right price for this, and that I'm not just giving away the value on the way in.
Well, I think it's worth mentioning the fiduciary responsibility on the other side for the founder as well.
Exactly.
If you have no investors, congratulations, right? You can keep 100% of the proceeds and then go pay your taxes on it, right? But if you have a complex cap table and what's called liquidation preferences, so we call it we don't call it this, the industry calls it a waterfall.
Right.
So you have to do the waterfall analysis that says, hey, if we're selling this company for $100 million and an investor came in a year and a half ago at a $20 million post money at a $5 million investment, but they have what's called a liquidation preference, or there's a concept in venture of you have preferred common shares, preferred shares, and then there's this one word called participating preferred shares.
Mm-hmm.
And that participation means they get their $5 million investment back and they still participate at their ownership percentage on the $95 million to be paid. And when you look at that, the liq pref or liquidation preference for the founder, I've had founders look at the liq pref when we did this early in the process, and they're like, it's not worth it for me to sell yet because I've spent 7 years building this. And the answer is, well, right? It feels like I had a job. So it's one of those that you have to be aware of you have to be aware going in what you need to be done and corrected. And I think for a lot of, there's some great coaches and great dynamics, and really when you choose a coach for growth and any of the scaling up stuff, this combination of what's the right platform and who has the right chemistry for you and knowledge of your business. But if that person has never exited a company before, it is not time to break in, a new coach on, hey, I don't know, but I can learn it, right? So that was my problem on my first go around was, I went and pulled the book, and then finally I hired somebody because it was just like I'm running into landmines at every turn.
Right. Yeah. And I think we've met a number of those kinds of coaches, and I've worked with great coaches, but I tend to agree with you. So, talk to me about trajectory then. This is the new approach to how you can successfully take your business to market.
So at first I was working on a book. I did the first book for a trajectory startup. So I was going to do a trajectory scale up. And I got to say, after reading all this stuff, there's some great stuff in the space, right? Mm-hmm. Vern was the founder of EO. His stuff is great. The EOS and Gino Wickman's book is great. There's probably 4 or 5 books in the category that are just great content. So I parked the desire to do a scale up book and said, really, what I want to focus on is the exit side, because the exit side for the founders is something that's still opaque to the founders. And we've talked with a bunch of exited founders and said, hey, would you be interested in coaching if you had a platform and software to coach to? So originally I was writing the book for it. And with AI now, the great part is you can write a lot of code from this as well. So the idea that it can nudge you and remind you and look at quality of earnings as a score and give you a red, yellow, green pretty quickly and say, hey, here are the priorities you need to change. Some of them could give you a couple examples. You're currently on a cash basis in QuickBooks. Okay. Like it's taxably correct, right? And you currently maximize your offerings with your accountant and your controller to minimize your tax implications because you are the majority owner. That's cool, right? But it's not the best way to do it for maximizing your enterprise value. And that's not a weekend project. So to reconcile your last 3 years of financials from tax-based or cash-based to accrual-based is going to be probably a 6-month project. And let's say you took a family vacation at a trade show, and that's totally okay, right? I'm not criticizing it, but that'll count as an add back that increases your EBITDA. Mm-hmm. So one of the big ahas for most founders is they think about private equity is there's a concept of private equity bands. So let's say you're a managed service provider doing $1 million in EBITDA. The answer is you're not really big enough to interest private equity. But if you and a couple other managed service providers got up to 3 or 4 million in EBITDA, it would probably trade 2x to 3x that $3 million. So now those companies in total, where they weren't very interested in combined to get to 3 million, are now worth 9 million in exit value. The irony of it, or the interesting thing most founders don't know, is that if you had companies that had 10 million in EBITDA, they would trade for 12 turns or 12 times that. Mm-hmm. So you go from a 3 turns, right? So 3x to a 12x and 12 turns. And those bands have been incredibly predictable over the last decade.
Right.
So if you're a founder thinking about exiting, one thing you may want to think about is, should we combine with somebody first so that we get big enough to get to private equity, so we step up that valuation band and we go from a 2x multiple or 2 turns to 4 turns. Mm-hmm. So that's one thing I think founders just have never heard of before. And it's not something your coach will talk about.
Right. And the within that, there's, as you're saying, the price at 1 million, 2 million, 4 million, it just goes up and up, right? There's a band, there's a number of companies I've worked with where 10 million is a band, 20 million is a band. But actually thinking about that in advance rather than, okay, here's my company, what's it worth? And then I think related to that, Dave, is, are you selling as a strategic acquisition or a bolt-on to an existing platform, or do you have what's needed to be the platform? Because that's a difference in valuation as well.
Right. Yeah. So I give you one right now in the category I'm looking at is registered investment advisors.
Okay.
If you have under 200 million of AUM as a registered investment, and by the way, registered investment advisors are the guys that were in college 5 to 10 years ahead of me that got training at Merrill Lynch. Mm-hmm. And they went from Merrill to their own business and they kept their book of business, and now they have $100 million AUM and they're ready to retire. Mm-hmm. The problem is $100 million AUM is too small. Right. But if you put 5 of those companies together and got to a $500 million in AUM, now that company's worth 2 turns or 2x. If you put 4 more together, it's not worth 2x anymore, it's worth 4x. So there's these bands of where if I'm smaller than this, I'm not even in the band. The answer is you have a nice little business, right? And that's not meant to be offensive, by the way, because I always laugh when big banks are like, well, that's a small business category because they're under $1 billion. I'm like, have I ever met any small business, any business owner who said, oh my God, I can't wait to start a small business? Said none of us ever, right? So you need to know the bands are there. You need to prep for that band, right? And I think the hardest part of the challenge of this business as trajectory is helping founders understand they need to start 18 to 24 months before they want to sell to increase their value 20 to 40% over what they would get, right? And it's a little bit of a comparison to null, but when they look back at it, they're like, oh yeah, that makes sense because we fixed these things. And those were strategic structural problems, right? And oh, by the way, I kind of got energized about the business doing this, right? So we kind of have 2 product on-ramps that we're using for founders. We do a weekend intensive program at a destination. So think a bedroom house in Vail or Palm Springs, and you will walk out with a plan from the weekend. These are the things. Yeah, I want to go do it yourself. Great. Right. These are the things you need to go do. The other is we'll come in and do the financial reviews. We're not going to give you a recast financial model, which is something you're going to need, by the way, for either of these. The challenge with paying your accountant to do this is if they get it wrong, you have an unusable model. And I've seen so many of those because they didn't nail the business metrics first. And the business metrics are, what's your marketing conversion rates? What are your marketing channels? What's your sales cycle? How long does this take to close? From the first book, I will tell you, there's 5 factors in product market fit, right? So I'll give them to you. 4 of them trend up, 1 trends down. The traffic on your website, is it trending up or not? Right now, it's not spiking 1 month. That's not my point. This is like quarter to quarter, month on month trend. Are my leads as a percentage of traffic trending up? Is my customer count as a percentage of leads trending up? And is my average revenue per contract or average contract value trending up? And the last one is my time to close trending down. If I have those 5 factors, you have the basic data you need to build a good financial model. Right. If you're guessing at 2 of those 5, yeah, you have a start. But when you build a new pro forma, the pro forma is likely to be wrong. So we want to build that now, test it for 6 to 9 months, and make sure that your forecast actually is spot on. Because here's what happens. You hand somebody your pro forma, you sign the LOI, you're busy working on the deal, you take your eye off the ball on sales, and you miss your numbers. Guess what? Your price is going to go down.
Right.
Or you're going to go reshop the deal. And the cost of reshopping a deal is as expensive as the price of the going down in the negotiation. So it's just there are things you have to have nailed down in advance, and they sound super simple. They are.
Yeah.
You just have to be really disciplined about them. And that's where we can come along and help.
The fascinating thing that it is, we talked about some of the things that every founder or business owner needs to know walking into to this phase, right? Which is, am I financial solid? Am I out of the business as an individual so that the team is leading the work that's going on? But then the other piece you talked about is, here are the industry specific things if I'm a commerce business, right? And each individual industry will have some of those. Pulling those together, it's almost like, you review your financials each month to see how you're doing. But if you were reviewing your enterprise value metrics, then you can start to see what value you're adding to the transition when it comes.
Yeah, we're starting with that for 2 sectors. So technology companies, because of the strategic value, and most of that data is not posted. So we're functioning under a give to get data model, which is if the bankers want some feedback on the mark to market, we'll give it. But the ranges are pretty broad to start, because one company sells to Google for 10, one company sells for 40. And the answer is, well, they didn't have any revenue. What's your number? Right. So the second component there really becomes one of, are we ready to sell? And so from a readiness perspective, you're really thinking about what things do I need to do to be ready to sell before the date. Right. So yeah, those are the things that we're working on right now to help founders move the ball forward so they don't get surprised later. Right. That's awesome. It's better to come in and get the report before you give it to the board and say, I'm going to go take care of these things before I tell the board. And then you can create that as part of your dashboard. It really is like compliance, right? So some businesses have compliance they have to report on quarterly. I would make this part of your board deck and say, these are the things that we're tracking on a quarterly basis that says, are we ready at some point if we're ready to sell? And you should know what they are. It's a good thing for an experienced CEO to have anyway.
Yeah. So if somebody wants to get in touch with you and either engage in the intensive or the ongoing work, where can they best reach you, Dave?
So the website is gettrajectory.com. So just Get Trajectory, and then Dave at gettrajectory.com is Fantastic. The email address. Yeah,
okay. Final question. Yeah. Final question. If you were to go back to your first startup, and you've got all of the knowledge that you have today, what would you do differently back then?
Well, I think, timing is always such a crazy question, right? And being in venture capital for a decade, I would say the funny thing is about most VCs will say our timing was really great on that investment. And the answer is you wrote a check, you didn't actually deliver anything, right? The founders are the ones who delivered on it. So timing matters a ton. So because we went through the tech bubble at the same time we sold the company in 2002. So for those folks who remember that, it wasn't a great time post 9/11 and post tech bubble to sell a company, but we had a really valuable strategic asset that we sold to the company who ended up buying for us. But we had a customer concentration problem, right? So we had too much revenue around one particular vendor. And knowing that now, it forced, we were trying to build as fast as we could. The company went from 0 to 32 million in sales in 4 years. So the answer was, we grew kind of fast. Right. But we still had a customer concentration problem. And knowing what I know now, I have to laugh too, Kevin, because there are businesses of the 6 that I've started, knowing what I know now, there's like at least 2 of them that I would be like, oh, hell no, I wouldn't even go there again. Right. So, So yeah, those are the things you look back and go like, I wish I knew. And I think that's probably for me, the thing that makes me happy about this next chapter of my life is I get to help founders in an area where it has been incredibly opaque in the past, and it doesn't need to be. And frankly, that's the value there is having, give you one last comment. We got an LOI on the company, the first one I sold. And my attorney looked at me and said, "You're going to need to get your own counsel." And I'm like, "What do you mean?" Right? We've been thought partners for this, for the last 4 years. And he's like, "Well, I represent the company. And now that we have an LOI, nobody represents you." And it was a little bit of an aha moment. I understand it. It's accurate for sure.
Mm-hmm.
Right. But the fact is I went from having somebody in my corner to having nobody in my corner. Mm-hmm. And I think that's really our only mission is helping founders get great exits.
Yeah. What a great way to finish this off. Dave, thank you very much for joining me today on the Mid-Market Edge. This was absolutely fantastic.
Great. Thank you, Kevin.
Thanks for tuning in to the Mid-Market Edge podcast. For more information, visit the Mid-Market Edge website at midmarketedge.com. Details are in the show notes. Remember to subscribe and like the show so you'll never miss an episode. And until next time, keep building your edge in the mid-market.